Professor Galaris, dear distinguished panelists. Thank you very much for inviting me all today, and Mr. Ntatzopoulos for inviting me to take this Delphi Economic Forum. It's really an honor. The danger of actually coming late in this panel is to repeat myself, and I have to echo most of what the previous distinguished speaker said. And I'll try to give a brief view of what the investor perspective has been, particularly the state of markets currently, as well as to be much more precise on banks and the capital markets landscape. It has been a very interesting landscape in the last few years. So clearly in the next few months, and the perception that the markets have is that by all means, the low rates environment will come to an end at some stage. And truthfully said, the expectation is that at some stage, the Fed rates increasing will impact as well the Euro economic zone. Clearly, and it was mentioned before, political risk we can safely say that it's on our back, particularly following the Italian elections, but we need to see the Italian elections happen first, as we don't tend to trust now the polls as we used to in the past. The calendar for 2018 is quite busy, and it's quite busy for the first half for Greek matters, both for the banks as well as the most important development, which is the end of the fiscal program adjustments in August. But the second half as well of the year is more of a European matters focus, particularly with the deadline set by Mr. Barnier around the negotiations on Brexit. And Brexit effectively will become live then for whatever it matters. As I said, Greece is an interesting market for capital markets. Particularly, I'll focus on debt because we have seen transactions come recently on that. Because the sovereign and the banks regain market access after 3 years. And that is new money coming to the system. We're talking about 2 billion worth of money. And demand for that from the investor community was more than 5 billion. The situation of the Greek banking sector has improved, but we all hear that more challenges lie ahead of us. As we're getting closer to the maturity of the third bailout program, the investor community is monitoring the Greek government negotiations with the institutions around what is the post-program protection framework. The top priority for the banks, of course, remains their balance sheet cleanup, the reduction of NPEs, not effectively creating new NPLs, and particularly implementing the targets agreed with the SSM on the NPE sector. Funding and liquidity conditions remain and have improved for the banks as they are on track to repay the emergency funds, the ELA. Bank capital levels remain well above the European average, and also what the regulator is at this stage asking them. And the potential relaxation, and actually yesterday's news of relaxation of capital controls depends on the ability of the banks effectively to finance on the markets. The banks have restored access to the interbank repo markets, both for Greek correlated and non-correlated assets, and that has been very important to reduce the ELA. The return to markets has effectively sealed and was sealed by successful consecutive transactions from all 4 banks on the covered bond space. And to be precise, the banks have only tested the market which is on a non-bail-inable instrument on this first half of the year, ahead of any announcement around the IFRS 9 and the stress test results. I have to say that in the next 12 months, we're expecting the banks to see and utilize the potential windows that will come from positive developments for both bail-inable and non-bail-inable instruments. And just to give you a kind of size of what is expected for the next few years, we're estimating about 15 billion worth of MREL or bail-inable instruments to be required by the Greek banking sector. And just to put that in context, that's not a lot. It's 120 billion we expect only in 2018 to be issued from the European banking sector. So the Greek banking sector is actively restructuring, and the ECB support is illustrating that the Euro framework of laws and regulations keeps the sector active and interesting for market participants. Undoubtedly, having market access needs 2-3 years of continuous stable economic environments and positive banking developments in the NPE, cost effectiveness, and income generation. The recent transactions we've seen in the market were predominantly placed to institutional investors, international institutional investors. More than 85 to 90% of that sold to international investors. And what I would say as a kind of quick statement is most of the investors were based in the UK, rather than what you would expect to see from traditional Euro countries in Germany, France. Although Germany, I would say in the UK, more than 40 to 50% was driving the demand of these instruments. The German investor base only bought 10 to 15%. The Nordics were there as well with 5 to 10%, and the Italians played a key role. But we didn't see a lot of French demand, although it was some substantial investors, but a single names, I would say. In terms of investor type, most of them, they were the big asset managers. More than 50% of that was sold to asset managers, and then about 15 to 25% was sold to either private banks or banks. The credit funds and the hedge fund community only participate in a small piece, about 10 to 15%. And that tells us a lot. The official lenders as well participated, and it's a testament of the support that we've seen in the Greek banking sector for many years now, particularly BRD and the IFC. Now, having said all that, and I'll stay brief, there's more to come for the Greek banking sector, and the Greek economy is in a positive trajectory. What we definitely need to see in the next few years and the next few months is a potential avoidance, I would say, of a partisan approach between the officials when it comes to the Greek banking sector. The fears of Brexit have been completely subdued, and the Greek risk is now moving towards pre-crisis lows. A number of investors perceive that Greece is going to follow the same pattern like Portugal or Cyprus, and all of that will be effectively a very strong case for Greece for the next few years, particularly leaving back the political risk. The only danger is that when the officials take such a partisan approach, as I mentioned before, to prove this banking system is not going to work and endorse one-side narratives, the institutions, I would say, have largely underestimated the resilience of the Greek banking sector over the years, and as it currently is and performing. So without further ado, I just want to give a positive tone to the Greek economic environment. And we expect to see more from the Greek banks from the investor perspective. Thank you very much.